Welcome to the Deep Dive. We're your go-to for really getting under the hood of recent developments and breaking down what matters.
Exactly. We cut through the noise, give you the key takeaways, and explore the why behind it all. Fast and thorough.
And today, we are definitely digging deep into Expand Energy's second quarter 2025 earnings call. That was held back on July 30th.
Yeah, and this call, it gave us a really fascinating look at how a major natural gas player is handling, well, some pretty dynamic market conditions.
And executing a huge merger at the same time.
Right. It's a really important one to unpack if you're trying to get a handle on the energy landscape right now.
So what we'll do is break down those headline financials first. Then we'll really get into management strategy, what they're actually doing operationally.
Mm-hmm. And we need to look at the bigger picture, too, the market context they're working in. And stick around because later we might even float a, let's say, provocative idea for you.
Sounds good. The goal here is to give you that full picture of Expand Energy's quarter and what they see coming down the pike, beyond just the surface level numbers.
Right, let's do it.
Okay, starting with that results snapshot. Because Expand Energy, wow, they delivered some pretty big surprises this quarter.
They really did.
Revenue came in at $3.69 billion. The consensus estimate, $2.57 billion.
That's a huge beat. What is that, like 43.6% above expectations?
Exactly. And compared to last year, a 631% increase. Just massive year-over-year growth there.
Incredible. And the bottom line?
Well, their GAAP EPS, that's the standard accounting profit, it swung to a pretty significant profit, $4.02 per share. That's a huge turnaround from the loss they posted the year before.
Okay, so big revenue beat, swing to GAAP profitability. That definitely gets your attention.
Right.
Now, I did see their non-GAAP adjusted EPS, the number that strips out some of the unusual items.
Yeah.
That actually missed consensus just slightly.
Yeah.
$1.10 versus the $1.13 expected.
A slight miss there, yeah. But I think you got to weigh that against the cash generation, right?
Yeah, absolutely. That's almost a footnote when you look at the cash flow. Net cash from operations was, $1.32 billion. Really strong.
Super strong. And they didn't just meet their cash flow goals, they actually raised their free cash flow guidance for the full year 2025, added another $425 million to the target.
And production looks solid too. 7.20 DFE per day, still heavily weighted towards gas, about 92%.
So strong numbers overall. And the market noticed, right? There was that initial pop in the stock after hours.
There was. Shares jumped pretty nicely right after the release. Seemed like instant validation.
But did that enthusiasm stick, or was it just about those headline beats?
That's the interesting part. The initial pop was definitely there, but the stock kind of faded a bit in the following days.
Okay.
Which suggests, a more nuanced reaction. Investors were clearly impressed by the company's performance, the execution, but maybe still a little hesitant about the bigger picture for natural gas prices. Despite Expand doing well, that macro environment is still a big question mark for some folks.
Right. Strong company results hitting maybe a wall of skepticism about the commodity itself. Classic situation.
Exactly.
Okay, well, that leads us perfectly into the next bit. Let's dig into the strategy and the financial discipline, because this is where Expand Energy's story gets really interesting beyond just Q2 numbers.
Yeah, the CEO, Nick DellOsso, he really hammered home this message. He said they're delivering more for less, outperforming every expectation set when we announced our merger. Talking about the Southwestern deal, of course.
And they back that up, right, with the synergy target.
They did. They boosted the synergy run rate target from that deal by 50%. Half. They're now aiming for $600 million a year by 2026.
Wow. And what does that mean in practical terms?
Well, it directly translates to freeing up an extra $425 million in free cash flow just in 2025. That's real money hitting the bottom line sooner than expected.
That kind of synergy beat is pretty remarkable, shows the integration is working, maybe even better than planned.
Definitely. And it makes you ask, how are they unlocking that extra value? Well, part of it seems to be capital efficiency.
How so?
Management announced they're cutting 2025 capital spending by $100 million. The new target is $2.9 billion.
Okay, cutting spending, but are they cutting production too?
That's the key thing, no.
Yeah.
They're maintaining their production targets while cutting CapEx. That screams efficiency. Doing more with less, just like the CEO said.
And they're putting that extra cash to work on the balance sheet.
You got it. They doubled their goal for paying down net debt, now aiming to reduce it by a full $1.0 billion within a year. clearly making the balance sheet a top priority.
So cutting CapEx, holding production, and paying down debt faster, that takes some serious discipline.
It really does.
But what about shareholders? Are they getting anything back amidst all this debt focus?
They are. And that's what makes the story compelling, that balance. Despite the debt paydown push, Expand Energy returned $585 million to shareholders just in the first half of the year.
How'd they do that?
Through a mix of their base dividend, the variable dividend, and also share buybacks.
Okay, so it's not just about debt reduction.
Not at all. Management was pretty clear. They see their investment-grade balance sheet as a huge strategic plus. Their thinking is strengthen it when times are good, like now.
So you have flexibility later.
Exactly. Flexibility to do things like buy back more shares if the market gets soft later on. It's smart, long-term thinking, building resilience.
And there was something about tax savings, too.
Oh, yeah. Big potential tailwind there. Recent legislation, that big bill people talk about, restored some incentives for domestic investment.
Right.
For Expand Energy, this means they're expecting pretty significant and long-lasting tax savings, which just adds another layer of financial strength to their outlook, boosts that long-term cash flow even more.
Okay, so financially disciplined, finding merger synergies, strengthening the balance sheet, and returning cash. Pretty compelling picture on the financial side.
Very much so.
All right, let's pivot to the operations side then, the drilling, the growth plans. Because this is where they're really showing their muscle on the ground, right?
Absolutely. They're not just talking about being efficient, they're proving it. Record-breaking drilling performance.
And they're chalking that up to using AI and machine learning, is that right?
That's what they highlighted. Using tech smartly. And it's not just buzzwords. They gave concrete examples.
Like what?
Well, get this.
Yeah.
They drilled the longest lateral well ever done by a single drill bit in U.S. land history. That was down in Southwest Appalachia.
Wow. Okay.
And up in Northeast Appalachia, they improved their drilled footage per day by 62%. 52. And even the Haynesville, it was up 25%.
Those are huge efficiency gains.
Massive. And the practical impact. They hit their production goals and their well count targets using fewer rigs than they initially planned.
Fewer rigs, same output. That flows right back to the capital efficiency we were just talking about.
Exactly. Technology driving real, tangible savings and performance improvements across the board.
And does this operational edge feed into their bigger strategic goals like LNG?
Definitely. It's all connected. Participating in the LNG value chain is a core part of their strategy moving forward.
What are they doing there specifically?
They're actively working on the midstream side, laying the groundwork needed to ship LNG. They see what's happening with Europe locking in these long-term gas contracts. And they view that as a really strong, durable source of demand growth, especially the EU setting up that huge $750 billion framework to buy LNG. This isn't a flash in the pan.
So they're building for that future demand.
Precisely. It underpins their plan to build out optional capacity up to 7.5 BCF per day by the end of 2026, investing today to capture tomorrow's market.
And their location helps with that LNG strategy too, doesn't it? Their asset base.
Hugely. Their portfolio is deep, it spans multiple basins, and crucially, it's close to demand centers.
How close?
Just think about their Haynesville assets. Within 300 miles of those assets, there's over 12 BCF per day of new LNG demand currently being built, expected online by 2030.
12 BCF a day. That's a massive amount of demand right on their doorstep.
It really is. And management made the point that basically no other company is better situated to feed gas into that growing Gulf Coast LNG complex.
Do they have flexibility in where they send the gas?
Yeah, they stress that too. They can deliver to different points like Eastville, South Gillis. Gives them options, which is a big competitive plus. You wonder if the market fully gets that geographic advantage yet.
Good point. And speaking of the Haynesville, didn't they address some concerns about, well, productivity data coming out of Louisiana?
They did, head on. There's been some noise about state-level data suggesting Haynesville well productivity might be degrading.
Okay.
But Expand clarified, look, that seems to be largely a reporting issue at the state level. It's not specific to their wells.
So their wells are performing fine.
Better than fine, actually. They showed their own data, consistent year-over-year well performance going back to 2020. In fact, they've seen improvement.
How are they managing that?
A few things. They mentioned adapting how quickly they draw down wells based on prices, using about 15-20% more proppant. That's the sand used in fracking in their completions.
More sand, better wells.
Right. And crucially, they have their own sand source, which helps keep costs down, so they're getting better performance efficiently.
And they think the rest of the industry might see declines.
They suggested that, yeah. As drilling moves outside the very best core areas, they expect you might see broader industry degradation, which, if true, just makes their own high-quality inventory look even stronger by comparison.
Okay, so operationally, they're firing on all cylinders, leveraging tech, positioned well for LNG. Seems like a strong story.
It absolutely is.
So let's connect this back to investors. We talked about that initial stock pop, followed by a bit of a fade. What's the context here?
It really points to that divergence we mentioned, the company's execution. Stellar,
Yeah.
but the market reaction, tempered.
And the reason seems to be skepticism about gas prices.
That's the general consensus. Despite management sounding really bullish on the call, and despite getting, I think it was 8 price target increases from analysts right after.
8 upgrades. Wow.
Yeah. But the market seemed to be saying, great quarter, but we're still worried about the $3 or $4 gas price needed to make this really fly long term. A disconnect, for sure.
And how does Expand stack up against its peers in this environment?
That's where their advantages really shine. You look around, a lot of other gas-focused E&P companies are guiding towards flatter production volumes. They're focused purely on just preserving free cash flow because prices are volatile.
Right. Hunkering down.
Kind of.
But
But Expand, because of the scale they got from the merger and because of those drilling efficiencies we talked about, they seem to have a real cost advantage. They can seemingly thrive or do better at lower price points than some peers.
And they use hedging to manage that price risk too, right?
They do. They have a pretty disciplined approach. It's systematic, but they also try to be opportunistic. They mainly use what are called costless collars.
Can you break that down quickly? What's a costless collar?
Sure. Think of it like buying insurance against prices falling below a certain level. That's the floor. But to pay for that insurance, you agree to give up potential gains if prices shoot above a certain higher level. That's a ceiling. You get downside protection without paying an upfront cash premium.
Okay, protect the downside, cap the upside a bit.
Exactly. And in Q2, they added a good chunk of new hedges, about 169 BV. The average floor price was $3.75, ceiling was $4.77, and these hedges go out quite a ways, into Q2 2027.
And those floors are above their break-even cost.
Comfortably above, yes. So it locks in profitability on that hedged production, de-risking their cash flows significantly. Smart move in a volatile market.
Makes sense. But despite hedging, management still sounds pretty bullish on the long-term gas outlook.
Incredibly confident, yeah, despite all the recent ups and downs in Henry Hub prices.
What gives them that confidence?
They pointed to concrete demand drivers. About 2 BCF per day of new LNG capacity, starting up between now and the end of the year. They specifically mentioned Plaquemines, Corpus Christi.
Okay, new export facilities coming online.
Right. Plus, you'll get more gas demand as facilities come back from maintenance and just generally from cooler weather heading into winter. Their view is simple. Demand growth, especially from LNG, is going to outstrip supply growth over time.
Interesting. So looking ahead, what are the key things listeners should keep an eye on? What are the potential catalysts?
Okay, few things to watch. There's a dividend payment date coming up September 4th, always gets some attention. More strategically, there's an investor day planned for October. Big one. They're expected to lay out a 3-year roadmap for their LNG commercialization plans. That could really shift the narrative if it's compelling.
Okay, the LNG roadmap in October. What else?
Keep an eye on winter natural gas prices, the strip. Where that goes will heavily influence sentiment. Also, watch for any potential joint venture deals on their Haynesville acreage. They hinted that could be possible, right? And management basically said, look, if we keep executing like this, the story stops being about just integrating the merger and starts being about accelerating growth linked directly to LNG.
And what about more M&A? Are they looking to buy again already?
They addressed that.
Yeah.
So their main focus is still integrating Southwestern and improving what they already have. They'll always look at opportunities, but they have very high standards, non-negotiables, they called them. No urgency right now.
And definitely not looking at, say, Canada.
No, they specifically ruled that out for now. Said the economics above ground there weren't clear enough for them. They're sticking to their knitting, focused on execution in their core basins.
Okay, that makes sense. Focus on delivering the value from the deal they just did.
Precisely.
All right, let's move to our This Is Not Financial Advice segment. This is where we toss out a trade idea, something plausible based on what we've heard, for you to think about.
Okay, so the backdrop is clear. Expand Energy crushed it operationally, great merger integration, strong strategic positioning for LNG.
But the stock pulled back after the initial pop because the market's still iffy on gas prices near term.
Exactly. That divergent, strong company story, weak near-term commodity sentiment creates an interesting setup.
So what's the idea?
We're thinking about a long diagonal call spread on Expand Energy, ticker's EXE.
Okay, long diagonal call spread. For listeners maybe less familiar, can you walk through that?
Sure, it's an option strategy. You do two things at once. First, you buy a call option that expires further out in time, maybe January 2026. And you pick a strike price that's a little above where the stock is now, say the $110 strike. This gives you exposure to potential upside over the longer term.
Okay, buy a long-dated, slightly out-of-the-money call. Got it. What's the second part?
Second, you sell a call option that expires sooner, maybe October 2025, and you pick a strike price that's even higher, maybe the $120 strike.
Sell a shorter-dated, further out-of-the-money call against the one you bought?
Exactly. Selling that shorter-term call brings in some cash, some premium, which helps reduce the net cost of buying the longer-term one.
Makes sense. So what's the logic behind this specific structure for Expand Energy right now?
Well, the rationale is multifaceted. You're capturing potential gains from the short-term option decaying in value, especially if the market remains skeptical about a big gas price jump by October. That premium decay works in your favor.
Playing on the market's current doubts.
Right. But at the same time, you keep exposure to the company's longer-term story through that January 2026 call. You benefit if those catalysts we talked about the October Investor Day with the LNG roadmap, maybe stronger winter gas prices start to play out and lift the stock into next year.
So it's a way to bet on Expand's execution and LNG story over the medium to long term.
Without needing gas prices to suddenly spike tomorrow. You collect some premium now from the short-term call, reducing your cost basis on the longer-term bet. It's designed for a scenario where the company keeps performing, but the market takes time to fully appreciate it.
Interesting structure. A way to potentially benefit from both time decay and the longer-term strategic narrative.
That's the idea. Again, not advice, just a way to think about structuring a view based on the current situation.
Okay, let's wrap this up then. To recap, Expand Energy's Q2 call, it really showed a company firing on almost all cylinders, wouldn't you say?
I think so. Successfully integrating that big merger, showing impressive operational gains, really sharpening their strategic focus on LNG growth.
They're definitely living up to that more for less idea, boosting synergies, cutting spending, strengthening the balance sheet.
And still sending cash back to shareholders. It really is a compelling story of execution right now.
It is. Which leads us to our final provocative thought for you, the listener, to chew on.
Yeah.
Given that the market seems hesitant, focused on current gas prices, despite the strong demand fundamentals Expand is pointing to, and despite their clear cost advantages. How much of that wait-and-see attitude is already baked into Expand Energy's stock price? And maybe more importantly, what will it actually take for the market to stop waiting and start fully pricing in that long-term LNG growth story and give them credit for these operational efficiencies?
That's the multi-billion-dollar question, isn't it? Something definitely worth mulling over.
Absolutely. And remember, everything we've discussed here is just for your information. It is definitely not financial advice.
Yeah, we've covered a lot from Expand Energy's call, but there's always more nuance. We really encourage you to dig into the details yourself, form your own views.
What stood out to you from the call? We genuinely love to hear your take.
Yeah.
But for now, that's all for this deep dive into Expand Energy. Thanks for tuning in to the Deep Dive.